Welcome back, everybody. We're going to be reviewing Facebook stock today, and for lack of a better word, it's taken a big old dump. Ever since earnings, Facebook has certainly been on a downtrend. But is it deserved, or is the market overreacting? I'm going to do what I know best and apply another DCF model to this baby, but be even more conservative. We're going to lower it to 10%. Before we get to that, let's run our other part of the analysis that we would normally do. So, first off is PE ratio. That has now dropped with current stock price to a 16. So yes, based on current metrics, Facebook's PE ratio is currently a 16, which makes it look even cheaper than it did before. Next, we're going to want to look at growth over the last 5 years for Facebook. That'll be looking at revenue growth, net income growth, and free cash flow growth. And you can see on the screen here that Facebook has certainly done just that. They've grown in all three areas: revenue growth, net income growth, and free cash flow growth. Next, we need to look at their debt. Are they properly affording their debt? Are they over-leveraged? Let's check it out. First things first, we want to look at the average last 5 years of free cash flow. That average is about $23.3 billion. And then we want to multiply that by 3, and that roughly comes out to $70 billion. So we want to see that Facebook's long-term liabilities are lower than this number. Their long-term liabilities are $18 billion. So not only can they easily afford that in that 3 years, they can also afford it with their last year of free cash flow with ease. The other thing I like to look at when it comes to debt is current ratio. Now that's just going to be their current assets divided by their current liabilities. Now technically any number over 1 means that they can afford the current liabilities with their current assets. However, I like to see the number closer to 2. So it's going to be $66.6 billion in current assets divided by $21.1 billion in current liabilities. It comes out to 3.15, so that is a check. All right, so now we are going to move on to the DCF model that I ran. Now we're going to be basing this DCF model on a 10% revenue growth rate. Now I have the model run out on the screen here, so let's take a quick look. We used a 10% growth rate projected off of the year 2021 and projected it out to the year 2026. Net income was projected based off the revenue growth, then free cash flow was projected based off the net income. The figures we used to help determine terminal value was our weighted average cost of capital at a 7.8% and a perpetual growth rate of 2.5%. We also had to apply our rate of return that we want, the discount rate, which was 12%. Remember, you don't want your discount rate to ever be less than 12%, because then at that point you might as well invest in an ETF or index fund that'll get you anywhere from 8 to 10%. Now, after all the numbers were ran out, the intrinsic value came out to $294.24, or we'll call it roughly a fair value of $294. So just for reference, on the previous model I did, it was based on a 15% revenue growth rate, and the intrinsic value came out to around $370. With all the up-to-date metrics and applying a 10% revenue growth rate, you can expect a fair value closer to $294. So based on the DCF model and the current stock price of $220, Facebook is currently undervalued by about 33.6%. Now, assuming you believe that Facebook can get 10% revenue growth over the next 5 years, the DCF model suggests that this is a buy. All right, everyone, thanks for watching the video. If you feel that it added value to your day, go ahead and give the video a thumbs up and make sure that you subscribe to the channel for similar content. Alrighty, that's going to wrap the video up. Thank you for watching, everyone, and have a great day.